Centum half-year investor briefing. This morning I'm joined by Wambua Kimeu, who is our group CFO, and we'll take the unmute. Sorry. Thanks. Let me start again. Good morning, ladies and gentlemen. I'd like to take this opportunity to welcome you to the Centum investor briefing. I'm joined this morning by Wambua Kimeu, our group CFO. For those of you who don't know me, I'm James Moria, the Chief Executive Officer of Centum. So we'll probably take 30 minutes to take you through the briefing, and we'll have an opportunity to ask for you to ask Q&A. And if you have any questions, please put them on the tab, and we'll also pick them and address the questions. Because of social distancing, I'm not joined typically by the rest of my colleagues, but they are online and available to address any questions you may have. Just some highlights about the businesses at the half year. Market cap 13.5 billion. We'll speak a bit about it. NAV 45.3 billion, and long-term gearing has come down to zero. The national scale rating A plus and A1. Are we on the same screen? Is what you see? Okay, thank you. So some key updates and performance drivers. I'll just start with our various businesses. Within the real estate business, we completed the reorganization of our business. We consolidated all our real estate portfolio companies, excluding Two Rivers Development Limited, where we are not the only shareholder. In TRDL, we have a 58% shareholding. So that still remains a direct subsidiary of Centum Investment Company. But the rest of our real estate activities, whether it's in Palmarina, Vipingo, Uru Heights, and all the other projects that have been done, those have been consolidated into Centum REIT. Over the past years, we funded this business using shareholder loans, and the objective of Centum REIT, which is now led by Sam Kariuki, who is our former CFO, was to get to a cash generation position where they could be in a position to repay the shareholder loans that we previously advanced to them. And I'm pleased to inform you that in the 6 months to September, they repaid 3.75 billion on those shareholder loans. We have a number of bulk land sales still ongoing, and so we expect further repayments, and I will be discussing that in a bit more detail. They have developed a strong pipeline of infill developments. These are various residential units, and in the last 6 months, they had incremental sales of 1.7 billion, and total cash collection was 650 million. And moved to close to 2.6 billion or 2.7 billion from where it was before. On the private equity side, we have about 8 assets there. Initially, a large number of these assets were impacted by the economic uncertainty that was brought about by COVID-19. However, by September, 5 out of 8 of them remained profitable in the half year 2020-2021, and none of them required any cash support from Centum Investment Company Limited. Marketable securities and cash, we closed the period with 8.3 billion shillings in marketable securities and cash. We took a view in 2019 that the economic conditions were likely going to be bearish, and so we pivoted largely towards fixed income, largely for capital preservation and optimization of yield, and that portfolio closed with an annualized cash return of 11.5%. On the development side, the major activity was largely on Akira Geothermal, where we concluded geothermal exploration that we were doing with one of our partners, and we had a positive finding, and now the next step is to work towards resuming exploration or drilling exploration activities. This is our total return. This is our total return statement. Investment income was 729 million. which compares to 3 billion last year. The 3 billion figure last year had a sizable amount that related to gain on disposal of our interest in the bottlers. We did not have any transaction in the period to September. So the investment income largely relates to interest income. It would have been better was it not for the fact that a number of portfolio companies, to support them, they retained dividends so that they could boost their cash position. So this is largely interest income from the portfolio. Operating expenses were down 4%. Finance costs significantly reduced, largely because of the repayment of the dollar facility and that we held, and also repayment of the bond in June. We had the bond for about 3 months in the year, April, May, June. So 73% reduction in finance costs. So PBT up 95 million from a PBT loss of 804. We then had revaluation losses, which is the unrealized gains, because we marked a number of the portfolio to market. As you are aware, the markets have come down and multiples have come down. And because of the decline in multiples, we then had to mark the assets to market. So that is what is sitting in unrealized gains. So the total return for the 6 months is 1.3 billion, which when you compare against the opening NAV of about 47 billion, gives you a return on opening NAV of negative 2.7%. So our focus was largely on two things. One was on capital preservation, ensuring that the NAV does not decline significantly. And that is part of the reason why we took a decision to pay down the debt, so that we could reduce the finance costs, because if the finance costs had remained where they were, they would have had an adverse impact on NAV. And the second is to ensure that we are cash positive. When you look at our operating expenses, finance costs, we're able to fund it from recurrent income. So that was our objective, and I think although it is not a positive movement, I think under the circumstances, especially given that this was the heart of, this was the core of the COVID period, I think we are satisfied with what we achieved in terms of preserving value in the period. That is the movement in our NAV. So the NAV as at 1st of April 2020 was 47 billion. We had an operating profit just slightly under 100 million shillings. We paid out a dividend of 800 million shillings, and the unrealized value movement is 1.39. So that explains to you, that sort of breaks down the decline in NAV by 2.7%. It's largely on account of the fair value movement. And you may see also a decline in NAV per share. It's also because we paid out the equivalent of 1 shilling and 20 cents, which works out to roughly 800 million shillings in dividends in the period. Now that slide shows you how the NAV is split between the different asset classes, and I'll speak to this. So our NAV per share in our private equity asset class is 15 shillings, and I'll be speaking about it. Real estate, which is Centum really is 32 shillings, and of these 26 billion, there's a substantial amount there that is in the form of shareholder loans. You'll see it has come down from 29 billion, the investment portfolio sitting in Centum to 26 billion, and that is because Centum repaid a shareholder loan back to Centum Investment Company Limited, which is what has caused that drop from 29 billion to 26 billion. The target is was to get 7 billion of shareholder loans repaid by Centum, and these repayments are largely coming from this, ultimately financed by the sale of bulk land, and they have been quite successful in selling bulk land in some of their portfolio companies, which is why the borrowing figure, if you look at the real estate of 6.7, which was borrowing that was sitting on the balance sheet of Csr, which had been allocated to this business, is matched with a shareholder loan of 7 billion. So as they repay that money, that's the money that we've also utilized to make some certain repayments of debt at CICL. So that's why you have that decline. TRDL, which we own 58%, contributes 8 shilling and 60 cents of our NAV. The decline in the value is largely on account of interest expense, which was not capitalized. It was expensed, so that then leads to a reduction in NAV. Marketable securities, more or less where we began, a slight decline of 700 million shillings, which is largely because of the utilization of cash and cash equivalents. And you'll see that we've utilized some of that cash to repay debt in the period at CICL level. You will recall that one of our strategic pillars was strengthening the balance sheet through the repayment of debt. The actual marketable securities portfolio has gone up. What we've utilized partly is the cash and cash equivalents, which has come down from 2.9 to 1.7 billion. So NAV per share in March was 71 shillings and 30 cents. We closed at 68 shillings and 10 cents. If you are thinking about from a total return perspective, we then need to add back 1 shilling and 20 cents, which was the dividend per share that has been paid. So adjusted for DPS, it's 69 shillings and 30 cents. The differential is largely on account of the revaluation losses. And those revaluation losses, you can see them in the private equity portfolio, which has come down from 10 to 9.9. And also, as I've explained, in the TRDL and to an extent also on the real estate. We do not have any sizable revaluation losses on MSP, largely because these are fixed income portfolio. The share price, I want to speak about the share price. I have two slides that speak about the share price, and a number of investors have asked me about the share price. NAV per share is 68 shillings and 10 cents. Between 2019 and 2020, what we've really tried to do, it's been actually the last 18 months when we've had quite difficult economic conditions. We took a view that the market was likely going to be more bearish than bullish. Therefore, the focus was not so much on growth, further growth, but sort of managing risk downwards, shifting assets from liquid assets to more liquid assets, paying down the debt, and trying to realize cash. And that's what we've been doing so that we could preserve value to the greatest extent possible. The index has continued to come down, and the price also continued to come down in line with the index. But as you've seen in the previous slide, if you look at where the price was around 17 shillings, what are we doing? If you look at the PE portfolio and MSP alone, that is 15 shillings plus 12 shillings, that is 27 shillings. That is even just excluding our real estate portfolio. Centum real estate is at 2 shillings, and that, as you will see, is fairly cash generative with a clear roadmap towards making significant contribution to profitability. And TRDL is at 8.6 shillings. So even if one excludes TRDL, you're sort of at 60 shillings on an underlying NAV of what are profitable cash generative entities. We have a further analysis there that shows you where were the share prices of that in September, what was cash and marketable securities, and therefore what is the implied market value of the rest of the portfolio. So the implied market value of the rest of the portfolio is 7 shillings and 90 cents against an NAV of 46 shillings, because cash and marketable securities is sort of locked in. As we've also seen in the P&L, the company is able to cover its interest costs and operating expenses from recurrent income. So those are not eating into NAV. If anything, it's making a contribution to NAV. So there's a significant upside at the current valuation of 17 shillings. There's a very sizable upside on the share. This is our cash flow. If you look at September 2019, we began at 252 million. We then took a decision. These are exits we've been working on for a long time. That last year realized that just short of 20 billion. And had we really not taken these exits, we had a lot of value at risk. if you look at the impact of COVID-19 on that business that we exited, it has been quite severe. So had we not made this decision, the impact on EBITDA and even the ability to exit or realize this value may not have been there. So in hindsight, our view is that it was the right decision to make. And the bulk of that cash went into repayment of debt and reallocation of the portfolio to marketable securities, because what we are looking at was capital preservation and looking at pockets where we had created significant capital and which capital was possibly at risk of erosion. This year, we've had a further net cash from operations. You may be asking why the 3.9 is not reflecting in the total return statement. But that is largely because the repayment of shareholder loan does not flow through the P&L. It has flown through the cash flow instead. So although there are realizations happening at the real estate level, because those land sales are happening more or less at market value or at fair value in the balance sheet, there is no impact on the P&L, but there's an impact on the cash flow statement. And that cash, we've largely used it to make additional investments in the portfolio and to financing activities, which is 4.1 billion. That is further repayment of the debt, and that is really the bond that we paid, which is why you saw the closing cash and cash equivalents have come down to 1.7 billion. On to the portfolio review. I'll start off with Centum Real Estate, which is our subsidiary company. As I explained earlier, we now have our real estate business held in just two vehicles. One is the Centum Real Estate Limited and Two Rivers Development Limited. These are two separate entities. That chart explains what is within Centum Real Estate Limited. The objective of Centum Real Estate, the commercial strategic objective for us in Centum 4.0 was for us to get a cashback distribution of about 16 billion shillings from Centum Real Estate. And that has been broken down into two main ways. One is for them to generate a cash return of 9 billion from infill projects. Infill projects are largely residential projects that are being done on land that belongs to Centum Real Estate. This business pursues a market-led model, so they sell and then develop, as opposed to developing and selling. So they only develop what they have sold. So of the 1,482 units that are currently under construction, they have sold 1,086 units, and even in the COVID period, they sold a bit more. They sold about 89 new units, and it's largely a customer-funded business. So they increased deposits collected in the period from 1.95 billion to 2.6 billion as at September 2020. We had seen a slowdown in April and May, which was in the really heart of the lockdown. However, we've continued to see an improvement, and by the end of November, or at least as of yesterday, this deposit figure was at 2.95 billion shillings. So they collected another 350 million shillings in the months of October and the first 3 weeks of November. And the profit potential, which is both profit from the units and the cash from the land that we have bought to build the units, of what is currently market validated is 4.2 billion, which is almost 50% of what the target is over the next 5 years. So we'll be explaining that as we hand over these projects, it's only at that time that we'll be able to recognize the income. At the moment, these deposits are carried in their books as payables, and we are not yet recognizing any income. To September, I think September, October, there was a handover of 2 projects, and we're expecting a handover of that project. So when we announce the full year results, this particular infill development should make a contribution to profitability. The second goal was for them to repay their shareholder loans. This was largely to be funded from sale of bulk land and development rights. The target was 7 billion, out of which by half year they had repaid 3.75 billion. They have a healthy pipeline of land sales, and so we're expecting more repayments to come through over the period. So one can see how we are sort of working towards realizing the 25 billion or so that you saw in the NAV statement breakdown, shifting it from Centum Re and making a cash distribution back to Centum Investment Company Limited. This sort of shows you how the infill development has evolved from September last year to September this year. So if you look at the first row is the number of units under construction. September was 1,300. September this year is 1,482. That's because they have launched one new project. The number of units sold in September last year, same time last year, was 787. As at September 2020 was 1086. Last year, same time, we were 61% sales level, there was 61%, March 69%, and September 73%. Pre-sale level. The revenue potential of what had been sold has moved from 5.8 billion to 7.5 to 9.2 billion. Deposits collected have progressed from 1.2 to 1.9 to 2.6. If you look at deposits as a proportion of the revenue potential, we were at 21% in September last year. In March this year, we were 26%. By September, we were 28%. Over 1 year, over the 12 months, despite COVID, they have collected about 1.4 billion in deposits to September. And if you take it to November, you add another 300 million. So that's sort of 1.7 billion. The profit potential has increased obviously because they've added one more project of market validated units, which has moved progressively from 3.6 billion to 4.1 billion. The balance of what the receivable they have to collect is, as at September last year, was 4.6 billion, March was 5.6, September was 6.6, and the reason the receivable has been increasing is, even though they have been increasing collections, is because they've also been selling more. So they're not just collecting, but they're also selling. The other number we track is the cost to completion. So if you look at September last year, we had 6.4 billion cost to completion. There's a ratio there which is cost coverage, which is where they track their balance of sales to collect and the cost to completion. So last year it was 70%, meaning if they collected everything that sold and sold no more unit, they were 70% covered. By March it was 1.1 times, meaning the coverage was 1.1. By September, there's a receivable of 6.6 billion versus a cost to completion of 5.4 billion, which is 1.2 times. Now, that is the reason why Centum Re as an entity is now issuing a bond, because these projects were largely, they had no debt, they were not leveraged, so that then they can bring in the bond proceeds to fund the cost to completion and then direct these receivables into the sinking fund to then repay the bondholders. That means you're able to divorce the completion of the project and the funding of the completion of the projects from the collection that they are making on an ongoing basis. So despite COVID, they have built a fairly healthy pipeline, and they are working on new projects which are currently under market validation. And those projects will only move from market validation to construction once they achieve a 30% pre-sale level. This year they launched two new projects. They launched the project in Kasarani. They launched Two Rivers Loft here in Two Rivers. Two Rivers Loft has been market validated, and that's why it's commenced. We expect Kasarani to have been market validated, about 216 units. They have sold about 60, so they're almost 30% there. So that should probably come into this chart by January of next year. We also moved to a strategy of developing on third-party sites. And the objective of that was for us to remain capital light, so that we don't have to spend capital acquiring the land, but we could capture a portion of the profit and leverage the brand and the development capability. So that's some of those projects, like in Kasarani, they are on third-party lands where we've gotten into JV arrangements with other developers to make sure, just as we are market-led, we have units that are available for the market, even where we do not have existing land parcels and where we don't really desire to put in more capital to buy land. So that explains the bond the bond that is currently open, which is being done by Centum Real Estate Limited. I've explained what it's being used for. It's largely going towards financing the completion of the construction of market validated projects. As you've seen, there's a very high level of pre-sales and there's quite a high level of collections even in this period. It's a zero coupon bond, it's a 3-year bond. The reason it's 3 years is because it's tying with the period of completion and collection. And the security is a floating charge over the receivables of the unsold units and a sinking fund managed by the trustees. So today these funds are being accounted for. They are sitting on our balance sheet as the consolidated balance sheet as a payable. They will move into a sinking fund, and that sinking fund will be charged to the providers to the bond holders held by a trustee. Centum received a credit rating of A2 and BB, and a BBB rating from a long-term perspective. You can access the prospectus for eligible investors. I've provided the link there. Two Rivers Development, where we own 58%. This is not part of Centum Real Estate. This is an entity that is held directly by Centum Investment. The mall occupancy is at 82%, which is commendable considering the impact COVID has had on the retail sector. Office, 20%, we are seeing surprisingly increasing demand for offices. You may see that number increasing by the time we complete the full year. They also have a pipeline of sales of land development rights within TRDL, and that is sort of the business model of TRDL is to sell development rights to developers. One of the buyers of those development rights so far has been Centum, where they have developed, got development rights to develop Loft and also to develop the Riverbank development. On private equity, 5 out of 8 of our assets remained profitable. The portfolio companies were resilient. They did not require any cash support. However, as a board in the various companies, we made a decision to defer the payment of dividends by the portfolio companies so that we could conserve cash within those businesses to support them through the COVID-19 period. A number of the assets have maintained their market leadership. One of our portfolio companies is Syrian Bank. As you know, banks have been affected largely on asset quality. What is encouraging is that actually Syrian's asset quality has gone up. We closed the year at 18% in March. By September, we were 12%, and that was largely because we had some large recoveries, which had a long time. So today, from an NPL perspective, we are slightly higher than, better than the market. We had loan restructurings of about 5.5 billion, but as at September, the balance of the loans that were still under restructuring because of COVID would come down to around 900 million shillings. So we've seen a significant improvement in the COVID-19 restructured book. The profit came down, and that is largely for two reasons. We have a very significant contribution of our profit which comes from non-funded income, and that non-funded income declined by that 8% because of reduction in trading activity in the economy. So we do not have as a higher non-funded income. And the second reason is because we had a higher interest expense because the business shored up its liquidity in anticipation, or rather in preparation of COVID-19. So that's why liquidity ratio went up 46%. And that led to an increase in the interest expense. Otherwise, I think what is encouraging is that we are fortunate in that we don't have a significant portion of the book having challenges, and therefore it is possible that we can, and also we've seen significant improvement in the non-funded income segment of the P&L. It's been improving progressively since August, September, into October and this month. So we are seeing some significant improvement in that book. Longhorn is in the education publishing business. It's also a listed company. It's a subsidiary of Centum. This particular business was affected by the extended school closure, which obviously reduced business activity. Also, uncertainty as to when schools would reopen did not help matters because parents did not know when to buy books. I think the fortunate thing with Longhorn is its geographical diversification. They have seen significant improvement in other markets, in Uganda, in Tanzania, in Cameroon. There's been significant improvement in those markets. We're also seeing, as schools prepare to reopen, new orders coming through for Kenya. But in the first 6 months, and you'll see the performance, they made a trading loss, and that was obviously consolidated into the group financial performance of Centum. Isuzu East Africa was initially affected. There's been a reduction in the number of new motor vehicle sales in the country. However, I think Isuzu was less affected than other dealers, so they gained market share to 40%. We had made a decision to withhold the dividend, but this was subsequently being paid in the post this particular period, post September. They have resumed the dividend payouts. Nasavea is in the airline catering business. It has about 90% market share. This business was impacted by reduced air travel due to COVID-19. We are hoping that as airline travel resumes, the business will pick up and there will be a recovery. It's one of our consistent dividend payers. The board made a decision not to recommend the payment of a dividend until we see full recovery in that business, so that they can conserve cash in the business to bridge them through this COVID-19 period. Zwari Leasing is a subsidiary which is in the leasing business, continue to see good growth and reasonable growth in profitability. On development, as I mentioned, I think the key activity was on Akira, which is a green energy project. We've been working on a joint on fresh geoscientific studies with one of our partners. These have taken the better part of 1 year. However, we concluded in September, October of this year, and the results were very, very, very encouraging. So we are now working on not just a drilling program, but Akira is working now on fundraising to fundraise for the next phase of its development, which is to get into the drilling, to resume the drilling phase. Marketable Securities, we closed at 8.9, previous year 8.3. I've explained why the movement was there. Largely sitting in cash, fixed income, mutual funds. They generated, this portfolio is managed by Nabo Capital, generated an 11.5% annualized gross return as at September 2020. Focus is on capital preservation and generation of cash, as we observe the way the markets are behaving, and as we get more cash out of repayments of shareholder loans from the real estate business, this is potentially one of the areas where we'll invest that cash as we look at what else is happening in terms of new PE opportunities. We had a number of CSR engagements, largely around supporting, mitigating the impact of COVID-19, and also on employment creation. On Nigeria, this is a partnership we have with the MasterCard Foundation, and that has helped over 42,000. We've connected 13,000 people with jobs. We launched a zero contact distribution system, which was used to distribute food at the height of the crisis, and the Agile learning. So these are activities we are doing with our various partners. I want to hand over to Ambua to take you through the financial performance. Thank you very much, ladies and gentlemen.
So thank you. Thank you, James.
Thank you, James.
Thank you, James. Thank you, James, for taking us through the performance of the business. So now I'll just look at the performance of the financial performance, and on the financial performance, I'll walk us through the consolidated position as well as walk us through the company performance.
Unmuted.
As you're aware, Centum owns quite a number of businesses, and given that we are an investment company, our key focus is normally on the company, and James has taken us through how the performance has been in terms of the statement of return, which is basically the company income statement. So for here, in terms of the consolidated income statement, this is just a summation of the businesses where we have control, or if I may put it, businesses where we own over 50%. So in terms of performance, James has mentioned earlier in terms that we sold the bottling assets, so that was a key differentiator. And by selling the bottling assets, that means that now we were not consolidating Almasi, which was part of our trading businesses. I think another key thing to note also on the trading businesses is that they've been affected by COVID in terms of trading performance, but subsequent to this, we've seen a lot of improved performance, as has been explained on the portfolio updates. So the trading loss was about 404 for the trading businesses. On the financial services, we had a 38 million shilling profit. And now if you look at our investment income, it was about 417. So I think in total, when you look at it from profit before tax, we had a loss of about 2 billion. This mainly driven by the finance cost. And if you look at our finance cost, this came down significantly following the payment by Centum of its bond this year. So on the other hand, so in terms of net profit from after tax, about a net loss of about 2 billion shillings. So if you look at this loss, once you take into account the comprehensive income of 1.7, really the key movements is that last year we had a very huge gain on disposal, and also last year we had a big provision, which was the provision we did for AMU of about 2.3 billion. So when you look at the 1.7 net loss after a total comprehensive income, then you can split it into two, where you look at what is attributable to Centum is really about 1.12 billion, and this is roughly the same number that you see from the company statement side. Also, because we have minorities, the performance of some of the businesses where we are not 100% owners had a loss of about 600 million, which is what is attributable to the minority shareholders, which is TRDL and Longhorn. From a consolidated statement of financial position, or the balance sheet as we look at it, I think for me here, just to make a few comments really. As we've mentioned, on the consolidated, it's a summation of all the balance sheets for the companies. But I think the key thing to note is that in as much as the bottlers have been sold, basically the balance sheet has remained in terms of a total asset, has actually grown from 101 to 108 billion. But I think the key things here to mention really is the impact of Centum Real Estate coming onto the balance sheet in terms of the projects that they're doing. So from an asset perspective, as they keep developing the projects, then the projects, we are carrying them as inventory. So you have inventory of the residential units that are being developed, and you can see this basically the increase from by 1.2 billion to about 4.2 billion. On the other hand, we have on the other side of the balance sheet the deposits that we are receiving for the buyers who are buying the units, and they are consistently paying, and James has taken us really through that. So the deposits we are receiving, both from the residential units and for the land sales, we have a total of about 2.9 billion. So what will happen is that this number for the deposits, as we start moving forward and handing over the units to the buyers, and when that starts happening, then this number starts moving into our income statement. And then also on the other hand, the inventory then starts moving to the income statement as a cost of sale. So you'll start seeing a very big a very big shift in our P&L as a result of the real estate business now contributing into the income statement as they now continuously hand over the units. I think one of the questions that has been asked has been, what is going to replace the bottler assets once they've been sold? What's going to get for you cash? What's going to be the impact of moving forward? So I think with the real estate business, with the projects now getting handed over, you start seeing that impact in our P&L. As you've seen, or as we've mentioned earlier, the total revenue potential is almost 9.2 billion shillings of the projects that we're doing. So that is expected to flow through into the consolidated income statement. On the company income statement, I won't spend time on this. James has covered it in quite a lot of detail. But I think it's suffice to say that the company income statement is basically being driven now by a lot of interest income coming in. As we mentioned, the dividend was lower. There was no dividend really. But the interest income coming in from our marketable securities and also from the shareholder loans that have been given to the real estate business is actually becoming much more significant. And you can see that in terms of the performance that we have. We've managed our operating expenses and our finance costs have come down. I think just to mention around what will happen with the real estate business, as they're making a profit, they will definitely be distributing dividends upwards. But I think the key thing to notice is that over time, we have already booked in revaluation gains previously that have gone through our P&L previously. So now as we go through the monetization element of converting this, the investment property, doing the development, having all that coming in as cash, then there'll be dividends coming and also there'll be a lot of shareholder loan repayments. And I think that's why you're not seeing the 3.75 coming in through here. But because mainly as that loan is being paid back, it means that we had already recorded the gains before. So the key thing I think for me I want to highlight about from the Centum position is that we have quite a substantial amount of retained earnings. If you remember, our first strategy was really to create value, and that value was created, went through the P&L and is reflected in our balance sheet through the retained earnings and the revaluation reserves. So we do have capacity to pay dividends and for a significant amount of time. So basically what will keep happening is that we'll be moving, as we keep realizing these gains, they'll be moving from the revaluation reserve in the balance sheet into the retained earnings. I think something else to note here is that we have shareholder loans we've given to the subsidiaries. So as they are becoming much more, as they're generating all this cash, and just similar way that we've gotten the 3.75, then the capacity to bring that money onto the cash flow into the Centum investment cash or balance sheet is there. Because what we'll just be doing is converting the 12.6 billion in shareholder loans into cash. And once you convert it into cash, then we distribute it to the owners of capital. We've mentioned earlier that our target is to have a zero debt balance sheet. We've paid down our long-term debt. And so the key thing, as you finish paying off the short-term debt that we have, then the balance is paid off as dividends. So what you'll keep seeing as we move forward is higher dividend payments as the cash comes in, and that may not necessarily reflect in the P&L of the company. So this is really what happened in terms of the cash flow statement. James explained quite a bit about it in terms of the money that came up from the shareholder loan that was repaid, the bond, we repaid that during the period, and the short-term borrowing. So we have a short-term borrowing of about 2.5 billion, which we use to bridge as we are closing all the other transactions in terms of the land sales. And this we expect to pay over the next 6 to 12 months. So I think as you look at our income statement as a company, then you'll see very big shifts in terms of, yes, you may not see it reflected in the income statement, but the cash flow statement is going to grow and grow significantly. Just to emphasize the point about our debt, is that when you look at the business from a trending perspective over the since 2016, we started off with debt of about 10.5 billion. We continuously took out more debt as we were making further investments in the business to a high of about 16 billion. And you can see as of last year, the debt that was remaining was only about 7 billion shillings. We paid down the RMB facility, which was a $75 million loan. That actually saved us quite a lot, on not just on interest payment, but also on the forex savings. On the other hand, we also paid down the corporate bond that we had at Centum. So basically, we have moved towards strengthening our balance sheet. And you know, when you look at strengthening of the balance sheet, I normally say it's really 3 items that you look at. Have you brought down debt significantly? That's number 1. Number 2, what's your cash holding position? We are now in a net cash position of net debt cash position of about 4.6. James has mentioned we are sitting on about 8.3 billion in terms of our marketable securities. And the other bit is your equity position very strong? And this really is the reflection of Centum, is that on all those 3 aspects, we have a very strong balance sheet. And again, more importantly, there has been very minimal, 2% impact on our NAV. I think that tells you the strength of our balance sheet. And that is what is making us weather the COVID-19 period much stronger and coming out much stronger than most businesses. So that was the financial performance, and I'd like to hand over back to James to give us a brief on the outlook. Thank you.
Thank you. Thank you, Ambua. Thank you, Ambua, for that presentation. On the outlook. On the outlook on the real estate, we're expecting there are a number of ongoing projects that have been handed over. So we are expecting that at the full year, we should have some additional income being contributed by the infill projects. We are also expecting the number of land sale transactions that are going on, which were delayed because of the closure of the lands office. And as those close, we're expecting further repayment of shareholder loans, which should further improve the cash flow position of the business. On the private equity, there's active portfolio management taking place. We are supporting the businesses for us to see a full recovery. They're also looking at new investment opportunities, but I must say we are very, very cautious. The market has been very uncertain, and it remains quite uncertain. And these are illiquid assets. So one wants to make sure that you need to be very careful if you're getting into an illiquid position now, to just make sure you've gotten in at the right valuation. Because what supports a lot of the risks that you're able to take on private equity is growth. If you are not sure about the growth side of it, then you may not have a sufficient return to cover you for the risk you've taken, particularly on illiquidity in the midst of the economic environment that we are facing today. So that's something we're doing. We have looked at more than 110 opportunities, and they continue to do so. But we are happy because the cash is earning a reasonable return as it is. So the opportunity loss of not closing is not high. Marketable securities, I think we probably will remain with that kind of portfolio. Focus is on capital preservation, optimization of the cash yield at minimal risk. The development portfolio, this is largely where I think we'll make more progress, is on Akira. Also moving some of our development portfolio assets like Greenblade, which were previously not profitable. They are now profitable. Our agricultural business is now profitable, and in fact, in the month of October, they paid a small dividend, or rather, they repaid part of their shareholder loan, and they are now making a contribution in terms of repaying shareholder loans. Somebody has already asked me a question about Akira, which I will respond now in the outlook. I think the question is how projects like Akira tie up with the issue of power demand. I think what I would like to explain, and my understanding, is that you have 2 kinds of power supply. You have baseload power and intermittent power. Intermittent power is from sources such as solar, wind, and the rest. That is power whose production fluctuates. Baseload power is power that is available all the time. And that power is largely from hydro, geothermal sources, and sometimes even thermal sources, because thermal is meant to be, the HFO power is meant to be peaking power. We still have a shortage of base load power. What we have a lot of is intermittent power and thermal power, which is why even if you look at what Kenjan I think was presenting earlier in the week, there's still a lot of focus on geothermal power. It's affordable, and it is base load. So there's still a lot of interest in getting that project moving. We have a 70 megawatt power purchase agreement. There's a number of projects that will be falling off as their PPAs mature. These are largely the thermal projects, which are quite expensive at call it 20 US cents per kilowatt hour. With the weakening of the Kenya shilling currency, you will see a lot more foreign currency adjustments, particularly on the fuel component. And so there's a need to shift towards this sort of baseload power. And also there's quite a bit of interest from investors. So that's how Akira comes in. Of the projects that are under development privately in the geothermal power space, I think Akira is probably the most advanced. So that's why we are focusing on progressing it, bringing in an investor and moving it to a level where it can be at commercial operation started. So that's the outlook. I think we are probably seeing, we've been through a very tough stretch. I think our P&L has been stress tested in an environment where bulk of our companies did not pay a dividend, and we still made an operating profit, and ended up with sort of a 2% hit on NAV. I think it's a satisfactory performance. Obviously, one would have wished that would have done a lot better, but you can only perform as well as the environment that you are in. I want to stop there and thank all of you for your kind attention and open it up for Q&A. Thank you very much, ladies and gentlemen.
So ladies. So ladies and gentlemen, I think the key thing, we have a tab there for questions, so you can kindly type your questions on the questions tab, and we'll be very happy to answer them. So we'll start off on the questions that have already been typed. I think James has already answered the question around Akira. I think the other question really is around Amu Power, and probably I'll ask James to take that question.
Yes, there are two questions on Amu Power. I think the question is, what is the current status of the project? We made an impairment provision in full. We have issued this company with a loan, and that loan is still accruing interest. But we did not accrue any of the interest, and we eventually impaired even the loan we had made to the company, because we realized the uncertainty the company faces with the court cases and the rest. So the company is carrying on seeing to what extent the project the form can be modified. But because of the sort of the confidentiality of the issues going on there, I'm not in a position to say a lot more detail about what is happening within the company itself. I'm restrained, but suffice to say, there's work taking place, and when we are of the view that there's likely going to be a positive outcome, we'll then be able to reinstate what we think is recoverable back onto our balance sheet. Somebody else has asked me about Njao has asked about he works with property developers to help them market and sell their projects. He knows several developers with great projects, but I need of funding. Might you be interested in funding them? As you've seen, Njao, we don't pursue a development-led model. We pursue a customer-led model. So what we do is that we respond to the needs of the customer. So if you look at the projects that we've done so far, like in Lipingo, for instance, the apartments that have been handed over in March, out of 440 units, only 13 are not sold, and even those 13, their letters of offer are issued. So to the extent that the projects have sold well and their collections, then maybe the Centum Re team might be interested, and that is Sam Kariuki and his team. but we've been quite disciplined in pursuing a market-led model as opposed to a development-led model where you then hope to sell at the end. And that's why these projects are fairly cash generative, and that has been a key focus for the development team. There are a lot more questions. Martin Kimani, this is shareholder loan while ring-fencing the bond payments. Okay, this is a very good question. Kindly expound on how Centum repays its shareholder loan to CICL while ring-fencing the bond payments into the sinking fund. That's a very good question. Centum is largely paying its shareholder loans from bulk land sales. So, as you know, Centum we transferred assets with significant land holdings, and those land holdings, they've been working on bulk land sales, which are not part of the developments that are taking place, and that is what they're using to repay the shareholder loans. The money that is coming from collections, that money even today we don't have access to it, because that money is going to fund the projects that are currently ongoing. So what people are paying in deposits, that money is what is financing the construction of the projects, and that money is ring-fenced at the project level even as we speak today. So the financing of the bulk of the shareholder loans is coming from the sale of bulk land sales, largely call it from the sale of land, not from the sale of infill projects, which is why if you look at the chart I put up, we've separated the two. There is a 9 billion expected profitability from infill projects, but that can only come at the end, once the project is completed and all the money is paid, which is why we're explaining that those profits will come as those projects are finished and handed over. Of that money, the 9 billion, they are sort of market validated 4 billion. Now the bond holders are going to finance the construction of the project, and the deposits that are coming are what will go into the sinking fund. Today those deposits are going towards financing the actual cost of construction of the project. I hope Kireni have answered the question. The shareholder loan, we've separated it, and that, as I've explained again, it's from the sale of bulk land, and we have quite a lot of bulk land sales in progress across the various developments. Is there any focus in investing in emerging, promising SME businesses? What does focus area look like, industries and sectors? This is from Collins Omwenga. So the focus now for the private equity business, because you have to dial down risk based on where the economy is more on companies with a proven track record of cash flow generation, because now you need cash generating businesses that are profitable and that have growth potential. So that is what the team is currently looking at, and where you can come in at a reasonable valuation. So we are not looking to invest in early stage investments, because unfortunately the way the economy is, it does not support that kind of risk at the moment. Despite the first half loss, Centum has not given a profit warning for the full year. Is the company hopeful for a substantial recovery in the second half, which eliminates the need of a profit warning? This is from Sunil. Sunil, as you know, our profits are quite sensitive to transactions. The first half of the year was not conducive to concluding any transactions. We always have a number of transactions in the pipeline, and depending on the timing of the conclusion, this would probably have a material impact on profitability. For example, last year we had a substantial transaction. The year before we had a substantial transaction. In fact, the year before we announced a profit warning because one of our transactions did not conclude on time. So I think we'll be in a position to tell this closer to year end, depending on where the current transactions we are working on, the position of the current transactions we are working on. We obviously have had a delay because of COVID-19, people being unable to travel, in the number of transactions that are in the pipeline. So that would be what would make us make that decision. We'll probably make that decision sometime in the next quarter. I think someone has asked me, when do you expect new investments under the new PE? What sectors are you targeting? Especially now that multiples are relatively low. I think Samuel, the experience in whereas the multiples are low in the markets, in the public markets, the multiples are not low yet in the private markets. Private market investor expectations are still very high in terms of where they, where people are pricing their companies at. That adjustment has not yet taken place. A number of sellers are looking at COVID as a temporary situation. So you sometimes find you have price misalignment. And as I've explained, one has to be very careful, because if you look at the PE portfolio, the one we've exited, and you look at the total return we had, only about 2 to 3% of that return came from dividend. The other 97% came from growth in underlying earnings. So you need to be fairly confident about the growth potential of the company, because if it does not come through, then you are unlikely to get a reasonable IRR. Now, because PE tends to be liquid, one has to be extremely careful. So a lot of work has been done by the team. As I've explained, they have looked at more than 100 opportunities, but we've not yet been able to close or on any, largely because of the downside risk assessment that we are doing. The fund is again demand led. It is led by the need to have quality investment. So you don't want to raise a fund and then be under a lot of pressure to deploy. Can you still see me? You don't want to raise a fund and be under pressure to deploy. So the key focus at the moment is on finding opportunities that we can be aligned on in terms of the value expectations. Some of my, I've missed, is there another question?
Yes, we have another question on Syrian, on valuation of Syrian, coming from Martin Kirimi. So he's asking, you value Syrian at about 0.63 times price to book. However, from a diluted share perspective, given the IFU convertible loan, don't you think the valuation is a bit rich?
Yeah, thank you, Kiremi. The IFU conversion price is 1.4 times NAV. So if they are to convert it, it would come to 1.4 times NAV, which is a higher price than what we are valuing Syrian at now, which, as you've correctly explained, I think it even, half year valued at 0.
We brought it down at 0.53.
So at half year we valued Syrian at 0.53 book. You are right if they were to convert, but if they were to convert, their conversion is at 1.4 times NAV. Next question.
I think we've answered most of the questions. You can still send questions. I think we've answered most of the ones that.
And you can still dial in, and you can raise your hand, and you can ask the question if you have any question before we close. This presentation will also be available online, and you please have a chance to look at it. There'll be another call at 3 p.m. I think we'll post the details on the website, and you can, if you have any further questions that probably you need time to go through and digest and understand, please feel free to log in at 3. Wambu and I will be on that call as well. Is there more questions?
So, no more questions? Okay. There's one person who wants to. Okay.
David? Can I ask a question?
Yes. David, please ask a question.
Yeah.
Thank you. Sorry, I'm driving. I'm listening the web as I'm driving.
Yes.
I just wanted to ask, is Centum still invested in the Nairobi Stock Exchange? Is it still invested in other stock markets? I've seen like Jubilee recently said that they do the stock market. So is our equity market still invested in the capital markets, because the return is mostly negative? Thank you.
Yeah. So David, up until 2019, we were invested in equities across various African markets, including the NSE. In 2019, we took a view that we should shift to more fixed income securities, largely to preserve capital, because we did not see the growth we did not think the growth would be greater than the yield. And so our exposure today to the NSE is very limited. I think of the portfolio you've seen there, it's probably less than 300 million shillings. That is the current exposure. David, have I answered the question? Yeah.
What about in other markets? What about in the other markets that you had invested?
In the other markets, we've substantially scaled back. The bulk of the portfolio is in fixed income securities. Yeah.
Thank you.
Okay.
Is there anyone else to the question before we close?
Okay.
There's one more. Kimadi.
Yeah.
Okay, Kimadi, please proceed and ask your question.
Yeah, good morning, James and Manuel.
Morning.
Can you hear
Morning.
me?
Yes, you can hear you, Kimadi.
Yeah, I wanted to get your view on the current share price for Centum. You probably covered it at the beginning, but I could have missed it. If you did, no problem, I can access the recording.
Yeah, so Kimadi, what I was explaining is that if you look at where the share price is, it was sort of 20, it's been trending towards 15, back to 17. Then you look at the disaggregation of the NAV, and you see what is underlying the company. Between our the marketable securities portfolio only is 12 shillings per share. So and it's covered in the presentation. And then you have the PE portfolio, which is about another 22. And then we have our Centum Re, which is about 30 shillings. And what we're explaining, and I've seen communication with investors on social media, what they were asking, is what is the ability of Centum Re to generate cash back to Centum. And that's something that we've been really focused on Centum 4.0, which is why Centum Re has been focusing on monetizing some of the bulk land that they have so that they could repay shareholder loans. And that's why we have a target of 7 billion shillings. They've done about half, they're halfway there. But also develop infill developments using our land. And then once they are complete, then return the capital back to the owners. So that is sort of coming through. I think what is important and what we've understood as management we need to do is to demonstrate that that is actually happening. And we've done it. And then probably do more investor communication to increase demand. I think the other constraint you've had is that because of the very stringent insider trading guidelines, insiders are in the market for very limited periods of time, typically 1 month after announcement. So in the absence of significant demand, that demand cannot be met by insiders, which was the case before, when we'd be in the market buying shares throughout the period. So I think recently there was an overhang of supply, which supply was not met with demand, and that caused the price to be significantly depressed. However, at the current price of call it even 17, it's sort of really misaligned from where the value is and from the cash flow generation potential of the business. I think the other concern I've seen investors having is asking what will be the source of cash of the business. And what probably we could have done a better job communicating is that even on our PE portfolio, the key cash flow was not from dividend. The key cash flow was from creating value and exiting. If you look even at the bottlers, combined we are getting only about 300 million shillings a year. So the cash flow from those companies was not as significant as the capital gain, which moved from almost 4 billion to 19 billion. And if we did not capture that gain, then we would have had a lot of value at risk. So the portfolio, the way it is now, we've created quite a nice pipeline of cash flows, and even in this depressed market, you're sort of still able to realize cash. So that's the what we can really work on is make sure the underlying fundamentals are strong and communicate, and hopefully then as the market conditions improve, then the price will also respond.
Maybe a follow-on question to that.
Yes, Kimadi.
Is given the significant cash holdings that you now have,
yeah,
are share buybacks an option you're looking at, and compared to other opportunities you could have for the cash, how does that compare?
So share buybacks are obviously even with the regulator, they have not yet the rules around that is still not yet in place, even with the regulator. So what we've done is focus on enhancing maintaining, having a sustainable dividend policy where we pay dividend consistently as we enhance the the cash flow. But then also the way I see it, as we build this cash and as we get cash from the rest of the business back to the center, there are going to be a lot of very good opportunities in this market for anyone with cash. And so, our obligation is also to do what is in the best interest of the company. And I think as that comes in, you're going to again ride another wave of growth. So it makes sense to move to cash now, be a bit disciplined when you pull the trigger, because you don't want to pull too early and then you're caught up with getting into very high valuations, and then see what other opportunities come up. Timothy, have I answered the question?
Yes, thank you.
Question? I can't see the question.
Yeah, I think the other question was on share buybacks, which we've addressed.
Yeah.
And also on the P. Yeah, on when the investments into P will happen.
Okay, thank you.
Yeah. Most of the questions.
I think thank you very much. I think we've addressed substantially the questions that have been asked. Thank you very much for your interest. We had very many people participating in this call. As we explained, will be available also at 3 p.m. We'll post this presentation on the website. Please look at it, and if you have more questions, please reach out, and also reach out through the Investor Relations tab. I would like to thank Wambua and all my colleagues in the various businesses who have worked very hard to deliver this performance despite what was a very challenging environment, and to thank all our clients who supported us. Thank you very much, ladies and gentlemen.